As of the market close on Friday, May 1, 2026, Navitas Semiconductor stock finished the session at $17.45 per share, marking a significant move of 5.76% to the upside. Throughout the day, the equity showed considerable volatility, bouncing from an intraday low of $15.81 all the way to a peak of $18.03, just pennies away from its 52-week high. This surge comes at a time when the broader semiconductor sector is feeling the heat, yet Navitas managed to separate itself from the pack by maintaining a strong bid into the weekend. While many traders expected a period of consolidation after the massive 110% run in April, the reality is that the market is beginning to price in something much larger than just a standard earnings beat. The immediate insight here that most people are overlooking is the massive accumulation by institutional players right before the Q1 financial results, which are scheduled to drop after the close on Tuesday, May 5, 2026. Typically, you see retail investors gambling on earnings, but the volume spikes we are seeing on the Nasdaq suggest that bigger funds are positioning themselves for a structural shift in how the company is valued. The general belief is that Navitas is just a small-cap player in the power chip space, essentially a niche provider for chargers and mobile devices. However, the deeper reality is that Navitas is aggressively pivoting into the high-power AI infrastructure world, a move that was solidified by the recent appointment of Gregory Fisher to their board. If you look at the recent partnership with NVIDIA regarding the 800V power delivery board, it becomes clear that Navitas is no longer just a peripheral player. They are becoming a core component of the power delivery architecture that allows massive AI clusters to operate without melting down. When you look at the recent daily swings, the momentum is undeniably bullish, but it is also creating a massive amount of tension. Investors using platforms like Robinhood or interactive brokers are seeing the stock sit near all-time highs, which often triggers a fear of a double-top reversal. Yet the trading volumes remain well above historical averages, indicating that the supply of shares is being absorbed by long-term holders rather than flippers. This institutional activity is a direct response to the company's Navitas 2.0 strategy, which focuses on GaN and SiC solutions for data centers and energy grid infrastructure. This isn't just about making phones charge faster anymore. It's about the $3.5 billion market for industrial electrification. While the public narrative centers on the upcoming earnings, the real story is the transition from a growth stage startup to a critical infrastructure provider for the hyperscalers. Most individuals doing self-investing often get caught up in the price action of giants like NVIDIA stock or Tesla stock, but the real opportunity often lies in the companies that enable those giants to function. Navitas is exactly that. Their GeneSiC technology is being integrated into 800V DC architectures, which is the gold standard for the next generation of data centers. While some investing sites might point to the negative earnings per share of roughly negative 0.57 cents as a reason to be cautious, the forward-looking market is focusing on the revenue growth trajectory and the expanding gross margins that come with high-voltage industrial applications. It's a classic case of the market valuing potential over current profitability, especially as the company works towards its goal of becoming a dominant force in the power semiconductor landscape. If you're managing an individual brokerage account or perhaps using Schwab Intelligent Portfolios to balance your tech exposure, you have to realize that Navitas represents a pure play on the efficiency side of the AI boom. Every time someone buys an AI chip, they need a way to power it efficiently, and that is where Navitas steps in. The tension between the expectation of a hold rating from some analysts and the reality of 100% gain in a single month is creating a curiosity loop that keeps the stock in the headlines. Is it overbought? Technically, yes, but in a market where AI infrastructure is the only thing that matters, overbought can quickly become the new baseline if the company proves it can scale its manufacturing. Comment below how many shares of Navitas you currently hold and whether you plan to buy more before the earnings call on May 5th. Do you think the high-power pivot is enough to justify a $4 billion market cap for a company that is still working towards consistent net profitability? To understand where Navitas is going, we have to look at what they actually do. The business model is centered on wide bandgap semiconductors, specifically gallium nitride and silicon carbide. These materials are much more efficient than traditional silicon, allowing for smaller, faster, and cooler power systems. Their GaN-fast power ICs are the bread and butter, integrating power, control, and protection into a single chip. This leads to faster power delivery and higher system density. On the other side, their GeneSiC devices are designed for much higher voltages, making them perfect for electric vehicle chargers and solar inverters. They have over 300 patents, which provides a significant moat against competitors trying to enter the space. Historically, the company has seen some revenue fluctuations, but the recent shift towards high-power markets is designed to stabilize those numbers and provide a more predictable growth curve.
Looking at the institutional landscape, we see names like State Street and Millennium Management holding significant positions. For someone looking at Fidelity Mutual Funds or Fidelity ETFs, you might find Navitas tucked into some of the more aggressive growth portfolios. Even if you prefer the convenience of the Fidelity mobile app or the Robinhood app for your daily trading, the underlying metrics for Navitas suggest a company that is being prepared for a potential buyout or a massive expansion phase. The high-voltage SiC market alone is expected to explode as the world shifts towards renewable energy and smarter grids, and Navitas is positioned right at the intersection of those trends. The future outlook for Navitas is entirely dependent on their ability to execute on the Navitas 2.0 plan. The catalysts are clear: successful Q1 earnings, more high-profile partnerships with companies like NVIDIA, and the continued adoption of 800V architectures in data centers. However, the risks are just as prominent. Any delay in the rollout of their fifth-generation SiC technology could lead to a sharp re-rating of the stock. Furthermore, the macroeconomic pressure of high interest rates continues to weigh on mid-cap tech companies that aren't yet turning a profit. If the reality of the earnings call falls short of the massive expectations built up over the last month, we could see a quick retreat towards the $12 or $13 support levels. But if they show that the high power pivot is translating into real orders and increased margins, the $20 mark is well within reach. In terms of investment help and strategy, many seasoned traders use the Interactive Brokers platform to set up sophisticated hedging strategies around these kinds of high volatility events. Whether you are doing online investing through SoFi Invest or using the SoFi trading platform, the key is to manage your position size. Navitas is not a widow and orphan stock. It is a high beta, high reward play on the future of energy efficiency. For those using Fidelity brokerage services or exploring Fidelity IRAs, adding a small slice of a pure play semiconductor leader like this can provide the kind of alpha that isn't found in broad market indices. It's about recognizing the difference between a company that makes a product and a company that makes the product possible. The central insight here is that Navitas is currently undergoing a valuation reset. It is being moved from the consumer electronics bucket into the AI infrastructure bucket. This transition is rarely smooth and usually involves the kind of massive price swings we've seen lately. The expectation was that Navitas would remain a small, speculative play, but the reality is that they are being woven into the fabric of the most important technological shift of the decade. They are solving the heat and efficiency problems that threaten to slow down AI development, and that makes them far more valuable than a simple charger company. As we look towards next week, the market will be hyper-focused on the commentary from CEO Chris Alexander. He has been vocal about the future of AI power, and any specifics regarding the ramp-up of their latest power delivery boards will likely be the primary mover for the stock. While investing sites might focus on the past, the smart money is looking at the 10 kW DC-DC platforms and the 98.5% efficiency ratings they are achieving. These are the numbers that matter to hyperscalers, and these are the numbers that will ultimately drive the long-term price action of the stock. In closing, the story of Navitas is a perfect example of the tension between market narrative and fundamental reality. People expect a small semiconductor company to struggle against the giants, but the reality is that Navitas is carving out a specialized lead in a sector that giants are only just beginning to prioritize. The authority they have built in GaN and SiC technology provides a solid foundation, even if the current stock price feels a bit stretched. By moving beyond the niche and into the heart of the data center, Navitas has changed the game for its shareholders. Whether you are using a Robinhood for fractional shares or a more robust Interactive Brokers account for full-scale trading, Navitas is a name that demands your attention as we move into the heart of 2026. Keep a close eye on the $17.45 level as we open next week. How the market reacts to that closing price will tell us everything we need to know about the strength of this current rally and the conviction of the bulls heading into earnings. This is where the narrative meets the numbers, and the result will likely define the stock's path for the rest of the year.